Ladies and gentlemen, close every tab except this one. Close Bloomberg. Close Twitter. Close whatever trading platform you're staring at. Yes, all of them. Even that incognito tab. I'm not going to ask why it's open. I'll just assume you're doing some sensitive research. Because what you're about to hear is not a simple silver rally. It's not a breakout. It's not a cute little technical story where some indicator crosses a line and everyone on social media starts talking about going to the moon. This is something much more serious. Something that reveals a fundamental failure in the market structure. Something that changes how you have to think about what silver actually is and how it trades. The global silver market has just split into two realities, two separate pricing mechanisms, two different markets that should be one but aren't anymore. And one of them is lying to you. One is showing you a price that doesn't reflect what the actual metal costs. Let me say it plainly so there's no confusion. The price you see on your screen is not the price of the metal. It's the price of a promise. It's the price of a claim. And overnight, that promise was exposed as fundamentally disconnected from physical reality. While the West is staring at COMEX silver trading above $85, while American and European investors are watching futures climb, Shanghai opened its overnight session with a bombshell. Silver futures on the Shanghai Futures Exchange, the SHFE, printed $94.70. Not struggling to get there, not hesitating. Just a clean open at a level that should not exist if the world still had one unified global silver price. And the spread, the gap between what silver trades for in China versus New York, blew out to roughly $9 per ounce. $9. Let that number sink in. That is not a premium. That's not normal market friction. That is a historic record. A divergence so large it screams systemic dysfunction. It's a sign that the bridge between East and West, the arbitrage mechanism that's supposed to keep global prices unified, has been severely damaged. In a functioning market, that $9 spread should be impossible to sustain. Every trading firm on the planet would do the obvious thing. Buy where it's $85, sell where it's $94, and move the metal. Through that process, they would crush that gap back to pennies. But the gap isn't closing. It's staying structural rather than temporary. And that tells you the only thing you need to understand about silver right now. The arbitrage, the mechanism that unifies global prices, is failing. And when that bridge breaks completely, you don't get a gentle convergence. You get an explosive repricing. You get one market suddenly discovering its price was a fiction. People love to treat silver like a ticker symbol, a paper game, where you can always click buy and sell. That's not what silver is. Silver is a physical supply chain metal. It lives in vaults, not databases. It moves in bars, not just contracts. It lives on trucks and in shipping containers crossing oceans. Arbitrage sounds simple in textbooks. Buy cheap, sell expensive. But that only works when you can actually move the metal, when you can source it in the cheap market, transport it, and deliver it to the expensive market. What this $9 spread is screaming is that you can't. Not in the size required. Not fast enough. Not without running into shortages, bottlenecks, and delivery delays. This is the moment the paper market starts to lose control. This is the moment when decades of price discovery through derivatives faces reality. Because when you see Shanghai printing $94.70 and the Western paper benchmark is still $9 lower, you're not seeing two opinions about value. You're seeing two different products that just happen to share a name. In the West, you're seeing the price of paper exposure, the price of derivatives, of claims against metal that may or may not exist. In the East, you're seeing the price of urgency, the price that industrial buyers facing shortages are willing to pay to guarantee they get the metal they need. And when physical necessity determines the value, the paper market doesn't smoothly catch up. It gaps, it spikes. It reprices in ways that leave paper holders stunned. This is why you must stop thinking in terms of gentle price adjustments. This is not a polite negotiation between markets. This is a stress fracture, revealing the system cannot function as designed. In a normal world, the spread creates an opportunity for risk-free profit. In the world we're in right now, the spread reveals an impossibility. It reveals that the arbitrage mechanism has failed. For arbitrage to work, you need three things. You need the price divergence, which we clearly have. You need the ability to source physical metal in the cheap market, New York. And you need the ability to deliver it into the expensive market, Shanghai. The first condition is screaming at us. The second and third conditions are failing. Sourcing physical metal in Western markets is getting harder. Delivering it from West to East faces immense obstacles. People underestimate how brutal physical constraints are until they try to convert paper into metal, until they try to take a futures contract and demand delivery, until theory meets reality. Buying a silver contract in New York is not the same as buying bars that can be shipped and delivered on time, in the correct form, into Shanghai. The silver market is full of inventory that looks available on paper, but isn't actually free-floating supply when you try to source it. The market structure that has governed silver for decades is now under extreme duress. The pricing you see in the West is for a paper promise. while the price in the east is for physical reality. This divergence is a warning. It's a signal that the fundamental nature of the silver market is changing right now, in real time. The disconnect between paper and physical is no longer a theory. It's a $9 spread on your screen. What happens when that paper promise can no longer be kept? That's the question everyone should be asking. When stress hits, when urgency appears, when multiple buyers try to turn paper into physical metal all at once, the first thing to vanish is the free-floating supply. The easily accessible inventory disappears. The amount of metal that is actually available for purchase shrinks to a tiny fraction of what the statistics suggest. And right now, that's exactly what the price spread is telling you. A $9 difference between what silver costs in Shanghai versus the West. That's what this divergence means. It's shouting that the millions of ounces needed to close that gap, the metal required to arbitrage away a $9 spread in a market this massive, is not flowing the way it should. It's not available. It's not movable. It's trapped or consumed or restricted. Now here's the part most market participants miss completely, the detail that seems minor but reveals everything. The overnight price matters more than what happens during regular trading hours, because overnight is where the market confesses. The trading is thin, the excuses run out, the algorithms aren't actively managing every tick. Overnight is where the price reveals what the next session will be forced to digest. Shanghai didn't hesitate at $94.70. That is the key observation. That's what should terrify anyone who still thinks this is just temporary noise. If this was just speculation, if it was just a temporary flare-up of enthusiasm, you would see hesitation. You'd see resistance and a fight at those levels. You'd see prices whip back and forth as profit takers sold and bulls bought, with the market searching for equilibrium. But a clean, confident price print, especially overnight, especially at a level $9 above the Western benchmark, signals something completely different. It signals demand that doesn't care about your chart, orders that don't care about technical indicators, flows that don't care about opinions or what analysts think fair value should be. This is the market behaving like a system under strain, like a mechanism that's been stressed beyond its normal operating parameters. And when a system is under strain, it doesn't resolve neatly. It doesn't heal smoothly or gradually return to normal. It resolves through events, through price gaps that shock participants, through spikes that trigger stop losses and force everyone to reposition, through rule changes that are designed to protect the system itself. The market has one job when physical stress hits. It must find the price that forces metal to appear, the price where holders finally sell, the price where new supply enters, the price where hoarding turns into selling. If the metal doesn't appear at $85, if supply doesn't materialize, if industrial users can't find what they need, the price rises. Simple supply and demand. If it still doesn't appear at $90, if the physical tightness persists, it rises even more. And it will keep rising until someone breaks, until inventory that was being hoarded gets released, until supply that was unavailable re-enters the market, or until the rules change. That last part matters enormously. When pressure builds and threatens the system's function, the system protects itself. Margins increase, position limits appear, delivery terms get adjusted, cash settlement becomes more attractive or even gets mandated. Frictions are deliberately increased to slow things down. But every time the rules change under stress, the market doesn't feel safer. Participants don't breathe easier. They feel more nervous, more uncertain, more convinced that something is deeply wrong. Because rule changes are a confession. They are the system admitting it is under stress and is now prioritizing its own stability over market function. And when people sense that, they run even harder toward physical metal. They demand delivery more aggressively. They refuse to trust paper promises. Now, you might be thinking, okay, Shanghai's price is high, there's a $9 spread. I get it. So what? I don't buy silver in Shanghai. This doesn't affect me. That is the wrong way to look at it. The right question is, what does Shanghai tell you about the real global clearing price for silver? About what it's actually worth when physical delivery matters? About where Western prices must eventually go? Silver doesn't live inside borders anymore. It lives inside global supply chains that span continents. If Shanghai is paying $94.70, if that's where metal actually clears when delivery is demanded, then somewhere on Earth, silver is worth that much right now. Not theoretically. Actually, in completed transactions, and if COMEX is still hovering above $85, $9 lower than where physical metal is clearing, it means one of two things. Either the Western price is about to be forced violently higher to match physical reality, or the West is about to discover that the screen price was never the deliverable price, that the number on the futures contract was always just a reference, and the actual cost to acquire the metal is something very different. That discovery usually happens the same way every single time. It happens at the point of conversion, when people try to turn their paper claim into physical metal. And they discover that the conversion rate isn't one-to-one. Premiums exist. Delivery takes longer than expected. Sourcing is difficult. That's when premiums explode. When delivery delays stretch from days to weeks to months. When out of stock becomes the norm. That's when the market stops being about a price and starts being about access. Can you get it? When can you get it? And how much over the spot price must you pay to actually get it? And physical possession always costs more than a paper claim. That's true in calm markets, and it's explosively true in stressed markets. This is how you end up with two prices. The price of exposure, which is what derivatives show you, and the price of possession, which is what the metal actually costs. And when that happens, the question becomes brutally simple. Which price is real? The price that delivers, always. The price where metal actually changes hands is the real price. The other is just commentary. This is also why silver's wild move matters so much for gold. This isn't just a silver story that stays contained. Silver isn't just a monetary metal or a store of value. It's a critical industrial metal, essential for technology and manufacturing. It sits at the intersection of financial trust and supply chain necessity. Gold is a confidence metal. It's about central banks, reserves, and wealth preservation. Silver is a confidence metal plus a supply chain metal. It responds to both monetary stress and industrial tightness. So when silver starts behaving like a market breaking in two, with record spreads and physical prices disconnecting from paper, it's not just noise. It's a signal about the entire global system, about whether paper claims can be trusted, about whether physical supply actually exists. Gold tends to follow, not because of some magical correlation, but because stress migrates. The logic spreads. The reasoning that applies to silver also applies to gold. When a market screams, "I don't trust the paper and I can't get the metal," that logic doesn't stay contained in just one asset. It spills over. It spills into gold, where similar dynamics exist. It spills into currency behavior, where trust is everything. It spills into capital flows as safe havens attract money. And that's why moments like this are so incredibly important to watch. Not just because they make for dramatic videos, but because they are giving us a live fire stress test of our financial system. The cracks are showing, and the price of silver is telling a story you can't afford to ignore. These overnight moves aren't just about clicks and views. They're important because they reveal structure. They show you how the system actually works beneath the surface. They expose mechanisms that usually stay hidden. Now, let's be absolutely clear about the core takeaway from this overnight session. A $9 SHFE COMEX spread is not a quirky anomaly, not a temporary glitch, not random noise that means nothing. It is a market diagnosis. It is the market telling you through price action, the most honest language it speaks, that the bridge is breaking. The arbitrage mechanism is failing, East and West are disconnecting, paper and physical are becoming separate products. And when the bridge breaks, when arbitrage dies, when unification fails, price does not gently converge. It leaps, it gaps, it reprices discontinuously. So what happens next? Where does this go from here? There are three broad scenarios. First outcome, COMEX is forced to chase Shanghai higher. Western paper markets gap up to match Eastern physical reality. Futures jump, spot reprices, and the benchmark adjusts to where metal actually trades. This is the bullish, explosive scenario where paper discovers it was wrong, and physical reality overwhelms years of suppression. Second outcome, Shanghai cools off. The premium collapses, demand moderates, and physical stress eases. The gap closes because SHFE falls, not because COMEX rises. This only happens if a new physical supply enters the Chinese market, if refining increases, exports flow, and buyers stop paying huge premiums. This is the system stabilizes scenario. Third outcome, and this is the most dangerous, the two-price world becomes permanent. The paper price becomes an irrelevant reference, and the physical access price becomes the only reality that matters. The bifurcation doesn't heal. Markets remain split. This destroys the illusion of a single global price and the confidence that paper claims equal actual metal. It creates a world where you don't ask what silver is trading at. You ask, can I actually get it? And what am I paying to get it now? Once the market shifts from price to availability, the repricing can be fast, violent, and psychologically destabilizing. Many people will only realize what's happening when it's too late. They'll look at the screen, see COMEX at whatever price, try to buy physical and hear not available, or 8-week delay, or the premium is insane. That's when panic starts. Not from the price rising, but from the price becoming irrelevant. Panic doesn't show up on a chart. It starts at the dealer, at the vault, at the moment of conversion when claims face reality. So here's what you should watch. Not as financial advice, but as structural intelligence. Watch whether the SHFE COMEX spread keeps widening. If it hits $10, $12, or $15, that's outcome 3 materializing. Permanent bifurcation. If it starts closing, watch how. Does COMEX rise to meet Shanghai? That's outcome 1. Does Shanghai fall to meet COMEX? That's outcome 2. Watch what happens in the overnight session. Does Shanghai keep printing new highs? Overnight behavior tells you about underlying demand. Watch physical premiums in major hubs like Dubai, Singapore, and London. Premiums are the market's way of screaming, this is hard to source. And watch for rule changes from the exchanges. Margin hikes, delivery restrictions. Those are system stress responses. If you want the simplest framework, here it is. When arbitrage dies, the market doesn't converge. It jumps. That's what this looks like. Shanghai at 94.7, COMEX above $85, a record $9 spread. This is a market revealing its fracture. And when fractures show up in physical commodities, they don't heal with tweets or analyst commentary. They heal with one thing, a price that forces real metal to appear. Or they heal with a rulebook rewrite, which usually makes the problem worse by confirming the fear that paper doesn't equal metal. So I'll end with questions you should answer for yourself. Do you think the spread closes because COMEX reprices higher, or because the system changes the rules? Which outcome do you believe is most likely? And what does that belief mean for how you position yourself? The overnight shock isn't just about price. It's about whether markets work as designed or break under stress. Right now, the metal is in the East. The West has paper. The question is whether paper can bring the metal back, or whether this is the moment paper dies. If you enjoyed the content, like and subscribe to the Exposure Index so you don't miss future updates.